Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Kayla Bio.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And it really helps the channel out.
Yeah, exactly. So let's jump right in, because we are looking at a situation today that is, well, mathematically jarring. I mean, it's the kind of setup that makes you double take when you pull up a stock chart.
Oh, for sure.
We're talking about Kayla Bio, which is a microcap stock right now, trading for literal pennies, sitting right around 29 to 36 cents a share.
Right, which usually tells a very specific and, a very bleak story in the market.
Right.
When a stock is trading at 30 cents, it's typically fighting off delisting notices. The market is basically pricing it for bankruptcy at that point.
Exactly. You see 30 cents and you just assume the market has left it for dead.
Yeah.
But here is the central paradox we really need to unpack today. Despite that penny stock valuation, consensus analyst ratings are actually maintaining a buy on this company.
Yeah, and they aren't just calling for a modest dead cat bounce either.
No.
They have massive price targets sitting between $31.50 and $34.
Which is just, let's put that into perspective. That implies a potential upside of around 8,500%.
Yeah, it's an astronomical figure.
8,500% sounds like a typo.
It really does. You just don't see targets like that unless there's a fundamental misunderstanding between what the company is actually doing right now and what the legacy stock chart is showing you.
Right. So today, we're going to break down exactly how a stock sitting at 30 cents implies that kind of potential. We'll explore the mechanics of this fundamental pivot they're making, the explosive technical momentum we're seeing, and the critical catalyst calendar over the next 3 months.
Because understanding this isn't just about this one stock, it's really about understanding how the market prices a complete corporate reinvention.
Exactly. And that reinvention is the only way to even comprehend those price targets.
Yeah, absolutely. And to understand where they're going, we basically have to look at the wreckage of where they just came from.
Right, the Ash to Phoenix story.
Right.
Because before you can entertain the idea of a $31 price target, you need to understand why this thing is trading at 30 cents in the first place.
Right.
And the legacy here is heavily tied to the classic bear case of the biotech sector. Just 5 months ago, this stock suffered a devastating 88% crash.
Yeah, an 88% haircut. It's the brutal reality of traditional biotech. They were running this eye disorder study, pouring years of time and millions of dollars into clinical trials.
Just burning cash.
Exactly. And in traditional drug development, a company's entire valuation is often pinned to just a single pipeline. So when those trials fail to meet their endpoints, the value of that pipeline instantly goes to zero.
It's totally binary.
Completely binary. You either have a blockbuster drug or you have absolutely nothing.
Wow. And the market reaction was violent, clearly. This failure resulted in a highly volatile microcap structure. We're looking at a massive 52-week range here, from 23 cents all the way up to $20.60.
Yeah, wild swings.
And that failure left them with incredibly lean cash reserves. They were basically forced to completely abandon their traditional biotech pipeline.
And, a management team in that position faces a huge crossroads. They can quietly close up shop, sell the office furniture, and return whatever pennies are left to shareholders, or
they execute a hard pivot.
Right. And what we're seeing here is an aggressive, complete pivot entirely toward artificial intelligence commercialization. They're aiming directly at the $180 billion AI healthcare market.
Okay, let's unpack this. Because as an investor, my alarm bells are ringing loudly right now.
Oh, I'm sure they are.
This sounds like a bakery burning down and the owner suddenly deciding to sell fire extinguishers.
That is a great way to put it.
Right. How do we know they aren't just slapping the word AI on a failed biotech company to chase retail hype? We see desperate companies do this all the time.
Oh, constantly. Remember the crypto pivot craze a few years back?
Exactly. Plus, developing AI is notoriously capital intensive. You need massive compute. You need highly paid engineers. If they just bled out from a failed biotech trial, how on earth are they funding an AI platform?
And that is the exact paradox we need to look at. Your skepticism is entirely warranted here. To find the truth, you have to look past the PR and dive into the mechanics of their balance sheet.
Right. The numbers don't lie.
Exactly. Is this pivot real? The financials say yes. First off, recent revenue actually hit $6 million.
Oh, wow. which is a step up from prior levels.
It is, but the most revealing metric here is how they're managing their earnings per share, or EPS, during this transition.
Because EPS tells you how much money they're actually losing per share while they try to pull off this operational shift.
Exactly. So recently, their EPS was sitting at a catastrophic negative 99.59. Ouch.
Yeah. But as they've initiated this pivot, that EPS has rapidly improved to negative 29.48. And if you look at the 2026 forecasts, they show those losses narrowing even further to an average of negative 0.90.
Wait, hold on. You're telling me their losses shrank dramatically while pivoting into the most expensive tech sector in the world?
That's exactly what the numbers show.
How does a company slash its burn rate by that much while building out an AI platform? Did they sell off legacy patents? Did they fire all the clinical teams?
Well, they systematically dismantled the clinical side of the business. Human clinical trials are massive cash furnaces.
Oh, right.
You're paying for patient recruitment, endless FDA compliance protocols, specialized medical staff, physical lab space, all of it.
So by abandoning the failed eye pipeline, they just shut off that massive cash burn.
Exactly. Software engineering, even AI development, has a completely different burn profile than physical drug trials. The dramatically narrowing EPS losses prove there's actual financial discipline here.
That makes sense. Yeah, they're efficiently channeling their remaining capital strictly into AI platform development instead of, attempting weird financial engineering or taking on toxic debt.
All right, so the financials suggest the pivot is genuine. They stopped the bleeding, and they're actually building an AI platform. But that brings us to the next massive hurdle.
Which is the tech itself.
Right. We have to evaluate the actual technology. Are they building a defensible product? Because the tech space is dominated by giants with bottomless pockets.
And their survival strategy there relies on becoming highly specialized. They aren't trying to build a general chatbot to compete with the big tech players. They're positioning themselves to build the Palantir for biotech.
The Palantir for biotech. Man, that is quite a title to claim. What does that actually mean for, someone trying to conceptualize the product?
It means they're building a secure, on-premises agentic AI designed specifically for analyzing pharmaceutical research and development data.
Okay, let's isolate those two terms because they seem crucial to understanding the moat here. On-premises and agentic.
Right. So agentic means the AI goes far beyond just answering prompts. It actively manages workflows.
Like an autonomous agent.
Exactly. In a pharma setting, an agentic AI can take a massive data set of chemical structures, run thousands of protein folding simulations overnight without any human intervention, and then autonomously flag the 3 most viable compounds for the human research team to review in the morning.
Wow. It actually takes action.
Yes. And on-premises means the software lives locally. It's installed directly on the pharmaceutical company's own secure servers behind their own firewalls.
So it's not hosted out in some public cloud environment.
Exactly. And that distinction is everything. Pharmaceutical research data, the molecular structures, the proprietary clinical trial results, that is their lifeblood.
Right, because a single chemical compound structure could be worth, $3 billion over a 10-year patent?
Easily. And if that data leaks into an open source model's training set, their entire pipeline is dead. Big Pharma will not upload that level of proprietary data to a generic, public-facing AI model.
The data security and specialized integration just have to be absolute.
100%.
Okay, here's where it gets really interesting to me, because it's the difference between using a public storage locker for your valuables versus, building a custom biometric vault in your own basement.
That's a perfect analogy.
But if I'm playing devil's advocate here, why wouldn't Pfizer or Johnson & Johnson just build this in-house?
Yep.
Or why wouldn't they just hire a massive general tech company to build it for them?
Because a general AI competitor, even a massive tech giant, doesn't inherently have the biotech-specific intellectual property. Caleb Bio has the institutional knowledge of having been a biotech company.
Right.
They understand the specific regulatory frameworks, the complex structures of clinical trial data, and the exact bottlenecks that slow down drug discovery.
So a general tech giant would have to learn all the intricacies of FDA compliance from scratch just to build a model that actually understands pharma workflows.
Exactly. So they're leveraging their past failure. They know exactly how hard drug development is, so they're building the software they wish they had when they were running those trials.
And that creates a massive competitive moat. When a major pharma company integrates a highly specialized, secure, on-premises AI system deeply into their R&D workflow, the switching costs become astronomical.
Yeah, you don't just rip out the brain of your research department and switch software vendors over the weekend.
Definitely not.
Once Caleb Bio is embedded in a big pharma client servers, they become indispensable.
Which introduces a very speculative, but I think very real catalyst for the stock itself. I mean, building out an enterprise sales cycle for this kind of software takes years.
Right.
But big pharma companies have massive R&D budgets.
Yeah.
If they see a specialized tool that accelerates drug discovery while keeping data perfectly secure, acquiring the company that built it becomes a very attractive shortcut.
It's a highly logical progression. Pharma giants are sitting on mountains of legacy data they just don't know how to analyze sufficiently. Caleb Bio is providing a modern pick-and-shovel solution to an industry that desperately needs to update its R&D models.
So an M&A event, an acquisition by a major player, is a real possibility if this tech proves itself.
Absolutely.
Okay, so the moat is real, the switching costs are high, and the fundamental pivot makes financial sense. But knowing the tech is specialized is only half the battle.
Right.
We have to connect this to timing. If they're sitting at 30 cents today, Wall Street isn't going to wait 3 years for a sales pipeline to mature. What is the immediate catalyst that keeps the lights on right now? Like, why is this analysis critical for your portfolio this week?
Well, to answer that, you just have to look at the recent market momentum. The tape has been explosive.
Yeah, let's talk about the tape.
On March 10th, 2026, we saw a 12.67% rise in the stock price, bringing it to roughly 29 cents.
Right.
But underneath that closing number, there were wild intraday swings of 27.20%.
Okay, when you see 27% daily swings, warning lights should be flashing on your dashboard. You're basically trying to jump onto a moving bullet train.
Exactly.
And the volume indicators totally back up how chaotic this is. We're seeing an average of 520,000 shares traded over a 5-day period with price gains.
But we really need to contextualize that volume. Because for a stock trading at 30 cents, 520,000 shares might sound like a massive float moving around.
Sure.
But in dollar volume, that's only about $150,000 changing hands a day.
Okay. That tells me this is still flying entirely under the radar of massive institutional block buying.
Exactly. Large hedge funds aren't moving the needle here yet.
So this is early stage, retail-driven conviction, or maybe small institutional players positioning themselves before the crowd arrives.
Yes. Even though the broader overarching sentiment scores for the market are relatively neutral right now, this specific stock is seeing highly concentrated action.
And volume is the footprint of conviction. When you see that kind of sustained volume alongside price gains in a microcap, it tells you the market is beginning to price in a binary event.
Right, and we have two very immediate catalysts driving this action. First, their initial commercial AI product is actually shipping in approximately 14 days, right around March 25th.
Oh, wow.
Uh-huh.
And second, their Q1 earnings call follows almost immediately after, on March 30th, where consensus expects to see that continued EPS improvement we talked about earlier.
Exactly.
But I have to push back here. With a recent short-term downtrend of 16% just last week, isn't there a massive risk that this momentum is a classic buy the rumor, sell the news trap?
It's a fair question.
Like, retail investors buy the hype leading up to March 25th, and the moment the product ships, the early buyers dump their shares and the price crashes back down.
Buy the rumor, sell the news is a real danger, for sure. But it typically happens when an event doesn't fundamentally change the underlying financials of a company.
Okay.
If we anchor this discussion to that March 25th product ship date,
Right.
we see a different dynamic. Shipping a commercial product isn't a rumor. It's the transition from theory to reality.
It's the moment they shift from being a cash-burning research lab to an actual enterprise software company with early revenue potential.
Exactly. The product shipping validates the entire Ash to Phoenix pivot. It proves the technology actually exists outside of a pitch deck.
Right.
Furthermore, you combine that internal catalyst with the massive macro tailwinds happening right now. We are seeing a broader sector rotation into AI healthcare.
Yeah, the broader market is finally waking up to the sheer size of this $180 billion space.
Exactly. Plus, potential interest rate cuts historically act as a major boost for microcap biotech recoveries. Lower rates mean a lower cost of capital, making it much cheaper for companies like this to fund their growth phases.
Which brings us to the ultimate question. We've laid out the fundamentals, the tech moat, the volume metrics, and the immediate catalysts. Now we have to evaluate those staggering analyst price targets and define the ultimate wealth-building strategy.
Right.
Because we are still talking about a stock trading for around 30 cents, with Wall Street targets of $34.
And to understand the path to that target, we have to map out the immediate technical setup. Right now, there is strong psychological and structural support sitting between 21 and 14 cents.
Okay, so that's the floor.
That's the floor. On the upside, there is a clear resistance band between 44 and 51 cents.
So 51 cents is the brick wall. And looking at the heavy volume, it feels like every time the price gets near that 50-cent mark, legacy bag holders from that 88% crash 5 months ago are probably using the rally as an exit liquidity event.
Oh, absolutely.
They're just trying to get out at break even, which creates massive sell pressure. So how does Kala Bio break through that ceiling?
Breaking that resistance entirely hinges on the upcoming AI shipping catalyst on March 25th.
Right.
If they ship successfully and the market digests the actual revenue implications during the earnings call on March 30th, that influx of new buying pressure could overwhelm the legacy sellers.
And if it punches through that 51-cent ceiling, that ceiling quickly becomes the new floor.
Exactly. And this is why we are seeing 2 to 3 major analysts maintaining firm buy ratings, specifically targeting that $31.50 to $34 range.
Which leads to the final investment thesis. Currently, Kala Bio earns an 8 out of 10 bullish score based on this setup.
Right. The strategy here, the elevator pitch for managing this setup, is a dual horizon approach. You're basically playing 2 different timelines simultaneously based on your risk tolerance.
Break that down for us. What does the short horizon look like versus the long horizon?
Well, on the short horizon, there is a swing trade opportunity heading into the March 30th earnings. You are essentially trading the volatility and the momentum of the product launch. You're looking to capture the price action as it attempts to break that 51-cent resistance.
Okay.
But on the long horizon, there's a multi-year hold strategy. If you believe their specialized on-premises approach will successfully make them the Palantir for biotech, you hold to capture the actual AI commercialization as they scale into that $180 billion market.
I still have to express some deep skepticism about that $34 target, though. I mean, even if they succeed, an 8,500% jump requires absolute perfection.
It's a tall order.
It requires flawless execution from management, aggressive adoption by conservative pharma clients, and the tech working perfectly on day one.
What if the product launch hits a snag? Are we just ignoring the bear case here?
We aren't ignoring the bear case. We're contextualizing it within the current price.
The risk of the product hitting a snag is incredibly real. But you have to understand how the market prices risk. Because of that devastating 88% crash 5 months ago, the current 30-cent price tag already embeds in prices in most of the downside.
Ah, I see the logic. The penalty for failure has already been paid by the previous shareholders.
Exactly.
The valuation has already been crushed to the floor.
The $34 upside targets aren't a guarantee that everything will go perfectly. They're simply a reflection of the mathematical reality of microcap valuations.
Right.
If this company successfully captures even a tiny fraction of a $180 billion AI healthcare market, their revenue completely eclipses their current market cap.
Wow.
At 30 cents a share, securing just 1 or 2 major big pharma enterprise contracts fundamentally reprices the entire company. A small slice of a massive pie translates into exponential percentage gains for the stock price.
So what does this all mean for you as you look at your portfolio today?
Yeah.
Kala Bio represents a textbook example of a high-risk, ultra-high-reward turnaround play.
Definitely.
It's a company leveraging the exact specific moment where traditional slow-moving biotech research needs dates with the rapid capabilities of secure agentic AI.
It is the ultimate ashes to Phoenix story. It's backed by a mechanical reduction in financial losses, a deeply specialized and defensible technological moat, and a highly active catalyst calendar sitting just days away.
It's a fascinating setup. Before we wrap up, I want to leave you with a broader thought to mull over. Kala Bio is fighting tooth and nail to become the Palantir for biotech. But it makes you wonder, as agentic AI becomes hyper-specialized and capable of running complex simulations autonomously, which other legacy cash-burning industries are about to have their traditional R&D models completely replaced by on-premise AI?
That's the real question.
Because if it can happen in the highly regulated world of pharmaceuticals, it can happen anywhere.
Yeah, it's a technological shift that is going to redefine the burn rate and efficiency of how every major industry conducts research. Those who adapt will see their margins explode. Those who don't will simply be priced out of innovation.
Make sure to mark your calendar for March 25th and March 30th to see how this specific story unfolds. Thank you for joining us for this analysis, and as always, stay curious and trade smart.